Welcome to today's fundamentals. Hello, Peter.
Hello.
What's new in the FX market?
Well, we saw practically the US dollar edging a little bit higher. I would be noting that on a fundamental level, the USD seems to have gotten some support mainly from market hopes improving about the possibility that the US default may be finally averted. It was characteristic that negotiations between Biden and Republican McCarthy practically seemed to be nearing a deal. And that was the main issue behind the fundamentals in the US yesterday. It was characteristic that despite Biden actually going on a trip that should be since today, and he will be out of the US up until Saturday, that would be for the G7 meeting in Japan. He expressed an optimism that they would be able to find a deal. And more or less, that seemed to improve market sentiment and lift the weight from the US dollar, allowing to edge a little bit higher.
And how about JPY?
Well, JPY is an interesting feature. On the one hand, it seems to be losing ground given that it experiences safe haven outflows, exactly due to the improvement of the market sentiment. I would be noting, though, that we had Japan's trade data early this morning. Now, the trade balance as such improved. It was a deficit and it narrowed beyond market expectations. That was quite good. But the issue here, which tended to pass a little bit under the radar, was that the trade deficit narrowed because we had a considerable slowdown of the exports growth rate and the import growth rate dropped into the negatives, which more or less tended to imply that economic activity in the manufacturing sector may be slowing down. And that's crucial on two aspects for JPY. A, because the Japanese economy is strongly export-oriented. And B, because the Japanese economy is also quite industrialized. So a slowdown of the economic activity in the manufacturing sector would mean a general slowdown of the Japanese economy, and that's not exactly good. I would expect attention for JPY traders to start shifting towards the release of the CPI rates of Japan for April. They are due out tomorrow during the Asian session. Now, should we see an acceleration as expected for the headline CPI rate, that would imply practically that inflationary pressures are still present in the Japanese economy and may increase the pressure on BOJ to actually lift or modify its ultra loose monetary policy settings, which are currently in place. On the flip side, should the CPI rates slow down, that may ease the pressure on BOJ and at the same time intensify the weakening of JPY.
Didn't we also have Australia's employment data today?
Yeah, it was also during today's Asian session. Now, we have to bear in mind here that yesterday during the Asian session, we had the wage price index of Q1 for Australia. It accelerated and tended to imply that inflationary pressures within the Australian economy continued to feed from the employment market. We saw the employment change figure, which, it was expected to drop, but it didn't only drop, it dropped into the negatives. And that tended to disappoint Aussie traders. It was characteristic that at the time of the release, the Aussie weakened around 35, 37 pips against the US dollar. And I would expect the release to actually, I wouldn't say force, but definitely prompt RBA to reconsider its hawkish stance, or at least to ease its hawkish stance. And I think that's the main element which may more or less continue weighing on the Aussie.
And what about the rest of the FX market?
Well, we had some interesting comments for pound traders from BOE Governor Andrew Bailey yesterday in the UK. BOE Governor Bailey, on the one hand, he stressed the fact that they expect in the next CPI release to see the rates for April actually slowing down considerably. They expect, as he has put it, a sharp drop. On the other hand, though, we have to note here that BOE governor practically, for the first time, admitted that the UK economy may be facing a wage price spiral, which is a big issue in the sense that should that be actually the case, that would mean that BOE has to hit hard on the UK employment market, and definitely that may have an adverse effect on the UK economy, as we have on the one side of the balance inflation, on the other side the employment market. I would expect pound traders today to keep a close eye over the comments he will be making before UK lawmakers, and especially given that he will be talking about monetary policy and inflation.
And how about US stock markets?
Overall, the improved market sentiment of US tended to support the stock markets, the equities markets. It was characteristic at some point, if I'm correct, Dow Jones rose around 490 pips, while also NASDAQ and S&P 500 were also in the greens. So overall, there is a positive market sentiment. Should that be maintained during today's opening as well, we may see US stock markets extending their gains.
And what's in today's calendar?
Well, we have a number of releases. I would be focusing mostly, though, on the US session. I would be making a start with the US initial jobless claims figure. It's the weekly figure. Sorry. Let's not forget that in the previous release, the figure jumped to 264K, a correction low as expected. However, that remains to be seen. Should the figure actually drop lower, that could provide some support for the US dollar. I would also be highlighting the Philly Fed Business Index. Should the index, it's in the negatives, actually quite deep in the negatives. Should it improve, we may see also some support for the USD building up. Other than that, I would be noting on the monetary front, we have a number of speakers. And I would be making a start actually with, BOE Governor Andrew Bailey, that's one. But I would also be noting ECB President Christine Lagarde. There may be some interesting comments for Euro traders there. And I would be highlighting in the late American session Dallas Fed President Logan, as well as I would be noting practically from the US the existing home sales figure. Mind you that we had yesterday the release of the construction data of the US, which were a little bit disappointing. We saw the buildings growth rate, the number of building permits dropping. It was expected to rise, as it also the new house starts figure dropped. Overall, that tended to highlight exactly how tight the construction sector in the US is currently in. And tomorrow we're getting the existing home sales figure, which could be highlighting the problems in the real estate sector of the US. So that's an issue. Now, during tomorrow's Asian session, besides Japan's CPI rates, I would be noting definitely New Zealand's trade data, with the focus being on the trade balance. And I would also be noting from the UK the consumer confidence, the GfK consumer confidence. Should there be an improvement, we may see the pound getting some slight support.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Iosif.
So welcome to the technical analysis part of the presentation for today. In front of your screens, you have practically NASDAQ. It's the 4-hour chart. It's where we left yesterday. And I had promised to complete this technical analysis as we started today. We ran a little bit out of time yesterday. So let's make a start. Readjusting the levels and the labels. Definitely the R1 13,400 has to be turned from a resistance line to a support line, given that the price action has moved decisively higher. It's currently aiming for the 13,730. Let's go hunting for a new ultimate resistance line. And I would like to recheck this level, the 14,230. Okay, it seems to be quite valid despite being quite wide. We had a nice sideways motion, wide sideways motion, and there were multiple tests on the level, so that should be okay. I'm raising the next level just a bit higher. Note the peaks here, but also here. This one. And that would be in red. $14,655. Locking it in. Readjusting the chart. Widening it fully. Correcting it lower later on. Repositioning now the labels. Starting with the S3, which is now being placed at 12,850. Sorry for that. The S3 at 13,145. And the S1 at 13,400. The R1 at 13,730. The R2 at 14,230. And the R3 at 14,655, we just located. Locking everything in, that's it. Now, let's talk direction. Definitely it's clear that the index has a clear-cut upward movement, which is characterized by continuous higher peaks and higher troughs, being the definition of an upward trend line practically. So overall, first sign would be that as long as the upward trend line remains intact, we maintain a bullish outlook. That's one. The second characteristic would be the RSI indicator. It's running just below the reading of 70, or if you prefer, along the reading of 70. Once again, highlighting the bullish sentiment on behalf of the market for the index. I would note, though, that the index may have approached overbought levels, or is about to. It's characteristic also how the index stabilized after breaking the upper Bollinger Band. Now it's just below it, but still a little bit high. Nevertheless, should the bullish sentiment be maintained, we may see the index rising, breaking above the R1 13,730, and that may lead it to an Odysseus journey towards the R2 14,230. It's a pretty wide spectrum. I wouldn't expect it to cover it in one go. We may see the index, should the bullish sentiment be maintained, breaking the R1, yet requiring maybe even a week to reach the R2. Talking about almost 500 points. Pretty wide. Okay, let's go and have a look also at Dow Jones. Overall, I would like to have a look at US stock markets. Now here we have a reverse picture, and it's very, very interesting. You can see that since this peak here, there was a downward motion, which was interrupted yesterday. And the pair tended to stabilize just below the 33,500. So for the time being, we tend to maintain a bias for the sideways motion to continue. Please note though that the Bollinger Band seems to have escaped or is about to escape the range around the reading of 50, implying that there may be some bullish tendencies. Should the bulls take over, I would expect the price action to rise, break the 33,500, and start aiming for the 34,160. Other than that, should the pair stabilize or remain stable, I wouldn't be surprised to see it continuing a tight range-bound movement just below the R1 33,500. For a bearish outlook, I would require the pair to drop. Definitely a lower true than this one would be required. So we may see the price action aiming, if not even reaching, the 32,830 support line. Okay. Let's have a look also at the S&P 500. Now, at this point, I think it would be useful to make a general calibration. We haven't visited this trading instrument for a number of, and I'm going to be tightening the levels. So allow me to turn this into a support line, given that the price action has broken above it and has even found support at that level. Let's go hunting for new resistance lines. Okay, the R1 has been verified a number of times. Once here, second time here. Let's go for the R2. Pretty narrow spectrum here. Yeah, they should be holding. You can see how this level was a price support line, but also provides some resistance, while this is the peak. Cannot miss it. There could be also some levels here. That would be far too narrow though. We're keeping those. Okay, let's readjust and starting with the R3, 4,325. The R2 at 4,260. The R1, which is now being placed at 4,190. The S1 placed at 4,155. The S2 at 4,100. And lastly, the S3 at 4,045. We have narrowed the distances between the support and the resistance lines. That's clear. Given that the movement yesterday, was to the upside, but it could have been wider. It wasn't. Nevertheless, let's log everything in. Let's talk direction. There are two elements which tend to imply that we may be at the start of a bullish movement. The first would be that the fact, or if you prefer, is that the price action was able to escape its upward boundary of its past sideways motion. That would be the 4,155, and practically is now trading above it with the level already providing support at some point. And that would be more clear in the 1 hour chart. You can see it here. Back to the 4 hour chart. Should the bullish tendencies be maintained, I wouldn't be surprised to see the price action breaking above the R1 4,190 and start aiming for the 4,260. On the other hand, should there be a stabilization, given that the S1 seems to be providing substantial support, I would be expecting the index to remain between the S1 4,155 and the R1 4,190. On the other hand, for a bearish outlook, I would require the pair to drop, break the S1 4,155, and I would also require it to break the 4,100 support level. That would be a more clear-cut downward movement, implying a bearish outlook. May also allow us to start drawing a downward trend line here. For the time being, the motion seems to be pointing upwards, and I would expect the bullish movement to be maintained, given also the fundamentals. Also note the RSI, which is at the reading of 61.9, so that tends also to imply some bullish tendencies for the pair. Let's have a look at Forex pairs, starting with the US dollar index. Okay, let's readjust the labels. That should be it. For the time being, we still maintain an upward, or if you prefer, bullish outlook for the US dollar index. And should that be maintained, we may see it breaking the 103.05, which is currently aiming, and start aiming for 104.5. So we're talking about 100 points or so. Now there are two elements supporting the upward movement. The first definitely is the upward trend line. The second is the fact that the RSI indicator is above the reading of 70, implying clear-cut bullish sentiment on behalf of the market for the index. I would be highlighting, though, also two other factors which may pose some difficulties for the US dollar index bulls. The first would be the fact that the price action is flirting with the upper Bollinger Band, so that may slow them down a bit. I would also be getting similar readings from the RSI indicator, which definitely highlights the bullish sentiment, but on the other hand, may also imply that the price action of the US dollar index has reached overbought levels and may be ripe for a correction lower. Should there be a stabilization of the index, I would expect it to remain between the S100 and 245 and the R1 103.05. While for a bearish outlook, I would require the pair to drop, break the upward trend line, break the S100 and 245, and aim, if not reach, the 101.55 support level. Let's have a look at Euro USD. We should be seeing a reverse picture than the index. And here we are. We are actually seeing such a reverse picture, given that we see that the downward motion was maintained, the downward trend line remains intact. It was tested, but it held its ground and continued to push the pair's price action lower. The RSI indicator is just above the reading of 30, implying a rather bearish sentiment on behalf of the market for the pair. I would expect the bearish movement to be maintained as long as the downward trend line remains intact. In that case, we may see Euro USD starting to aim for the S1 1.0715. On the other hand, should there be a stabilization, I wouldn't be surprised to see the pair breaking the downward trend line, guiding it, and that's since the 11th of May, if I'm correct. Sorry, the 4th of May. Now, in that case, a stabilization would be breaking clearly the downward trend line and remaining possibly just below the 1.0845, and I'm basing that on the fact that the level has provided ample resistance practically during yesterday's late American and today's Asian session. So it seems to be capable to hold off the price action from rising. On the other hand, should the bulls take over, yes, at that point I would like to see, or I would require the pair to rise, break the downward trend line, and the first sign that the downward movement has been interrupted. But also I would require it to break the R1 1.0845 and start aiming for the 1.0965. Moving now to cable. In a similar sense, however, there seems to be a catch here. Let me readjust the charts. Reposition the labels. Okay, well. Now there is a downward motion which is also being characterized by the downward trend line. On the other hand, we have to note here that the bears seem to be finding some difficulty actually proceeding to lower lows. Some even suggest that there has been a stabilization of the pair, and they place it practically in this sense. It's a very, very interesting idea here that we have some support, but please note that we have a bearish triangle here, which tends to provide the idea or support the idea for a further bearish movement. It's good. Under orthodox technical analysis, this would be a continuation signal, which would practically force the pair to drop, possibly break this level, and start aiming for the S1 1.2350. Also note that we have the RSI indicator, which is at the reading of 36. Maybe not as clear-cut bearish, but still seems to imply that the bears still have it, especially given that it corrected lower after hitting on the 50 reading. So we would expect the price action to drop and possibly break the S1 1.2350, thus paving the way for the 1.2185. Now, should the pair on the other hand stabilize, which is something which we cannot exclude given the fact that the price action seems to have hit a floor on the downside, then we would expect the price action to correct higher, break the downward trend line, but respect possibly the R1 1.2540 and remain within the channel we have noted. For a bullish outlook, I would require the pair to once again break the downward trend line guiding it since the 11th of May, but I would require also to break clearly the R1 1.2540, start aiming for the 1.2770. Let's have a look also at USD and JPY. The bulls have it. Oh yeah. Clear-cut bullish outlook in place here. It's characteristic how the upward trend line continues to guide the pair. The RSI indicator is above the reading of 70. It's actually at 73.5. All of that tend to imply a bullish sentiment and a continuation of the bullish outlook, in which case we may see the pair's price action breaking clearly the 137.75 resistance line, a level which provided support back here. That was at the beginning of the month, but it's also being clearly tested right now. Should that be broken, we set as the next possible target for the bulls, the R239.40. On the other hand, should the pair stabilize, say for example, if the R1 holds its line, and we may see the price action correcting a bit lower, breaking clearly the upward trend line, guiding the pair, and remaining in a sideways motion just below the R1 137.75. For a bearish outlook, I would require the pair to drop, break the pre-mentioned upward trend line in a signal of a trend reversal, a first signal of a trend reversal, and the price action to start aiming, if not even test, the 135.40. Let's have a look at USD CAD. Okay. Now USD CAD is clearly on the rise, and it's characteristic how it's aiming the 0.9020. There's an upward trend line guiding it. The bullish sentiment could be a little bit higher. It's currently at 63. But still, I wouldn't neglect it, especially given that it has risen a little bit. Nevertheless, for the bullish outlook to be maintained though, we would require the pair definitely to allow the upward trend line to remain intact, but also I would require a higher peak than this one. So I would require the pair to rise, break the R1 0.9020, and start aiming for 0.9115. On the other hand, should the R1 prove to be too much for the bulls to break, we may see the pair correcting lower, and remaining in a sideways motion between the R1 and the S1. For a bearish outlook, I would require the pair to drop, break the upward trend line guiding it, break also the S1 0.8935, showing how strong the Swissig actually is. Start aiming for 0.8860. That would be a little bit of an extreme case, but it's still a possibility. Moving to the Aussie. We have to shift the downward trend line a little bit to the right. Once again, similarly to the movement of the pound, we see that there seems to be a flow for the pair. That's AUD USD. Somewhere here. Which tends to create a downward triangle, a bearish triangle. In which case we may see the price action breaking below that level, possibly breaking also the S1 0.6580. Once again, a bearish outlook remains in place. I would be noting some worries here for possible stabilization though. The RSI indicators are here above the reading of 30, but still quite low at 35. So that may imply also some dominance on behalf of the bears, not a clear-cut one, but still a bearish sentiment is there. Should the pair stabilize, I would expect it to remain just below the 0.R16690 and definitely between the R1 and the S1. So for a bearish outlook, we would require the pair to break the S1. On the flip side, should the bulls take over, we may see the price action of AUD USD rising, breaking the downward trend line, but also at that point I would require clear break of the R1 0.6690 and the pair to start aiming for the 0.68. Let's have a look also at the CAD. In contrast to other pairs, the Canadian dollar remains in a sideways motion, and I think that's pretty clear cut. It's interesting how the past price action practically verified the validity of the R1 1.3545 and the S1 1.34. The RSI indicator continues to run along the reading of 50, also implying rather indecisive market regarding the pair's direction of the next leg. So I would expect the sideways motion to be maintained. Also note how the Bollinger Bands have been narrowing, have been converging, the upper with the lower one. Now, should the bulls take over, and I would mean a clear-cut rise, we may see the price action of USD CAD rising, breaking the R1 1.3545, and we next set as the next possible target for the bulls the 1.3665. To the downside, should the bears take over, I would expect the price action to drop, break the 1.34 and start aiming for the 1.3270. Albeit we have to note here that the S2 may be no longer valid, given that we had 1, 2 shows which tended to validate around the same level. So that would be much narrower, but still seems to be valid. And that would be the 1.3315. At this point, I would like to see whether the validity of the R3 is still present, still on. Let's go back. Definitely this is a level which we could not miss out. And that's the 1.3225. Okay, there's some wide distance between the resistance lines, while the support lines have been narrowed considerably. But I still view them as valid given the peaks they rest upon. So I'm keeping it. Okay, maybe the R1 could drop a little bit and the S1 could rise a little bit, but we're talking about 5 to 6 pips here, not material. Over the time, we tend to maintain our bias for a sideways motion to continue between the 1.3545, the R1, and the 1.34, the S1. Once again, should the bullish over, we expect the pair to rise, break the R1, 1.3545, and start aiming for the R2. While on a flip reverse downward motion, we may see the price action dropping, breaking the S1, 1.34, and start aiming for the S2, 1.3315. Once again, sideways motion in the base scenario, which is supported by the fact that the RSI indicator is running along the reading of 50, while the Bollinger Bands are narrowing. Note also the flattening out of the 150 moving average. Quite interesting. Let's move to the Kiwi, given that we have also New Zealand straight data tomorrow during the Asian session. Let's reposition the labels first. Now the price action has dropped, has broken the 0.6270, bounced beautifully on the 0.6190, and has hit a ceiling at the 0.6270, so that has to be turned into a resistance line. No questions asked. Let's go hunting for a new ultimate support line. We have that already. Okay, that's interesting. Where does it rest, actually? Have a look. Unlocking the chart. Okay. The S2 is resting here. The S3, we should go further back. Okay, it was a prior peak. Used to be a resistance line. Given that the price action is above it, now works as a support line. Let's readjust it. And let's also reposition the labels. $59.80. The S2 at 0.6090. The S1 at 0.6190, 100 pips up. The R1 at 0.6270. The R2 at 0.6355. Let's have a look. 6350. And finally, the R3 at 0.6430. Locking everything in. Let's talk direction. Definitely, we expect the pair to maintain a sideways motion. And probably that sideways motion will be just below the R1, 0.6270 for the time being, given its inability to clearly break above it despite having some slight bullish tendencies. It hit a ceiling there, at least for the time being. Should the bulls take over, I wouldn't be surprised to see the price action rising, breaking above the R1 0.6270 and start aiming for 0.6350. On the other hand, should the bears take over, and I would expect them to come into full force here, which would imply practically a breaking of the next target for the bears, which is the S1 0.6190. Look how it provided, it stopped the downward movement beautifully and reversed it. It screams for a support line. Nevertheless, should the bears take over, clearly I would expect the price action to drop, break the S1 0.6190, nothing less for a bearish outlook, and start aiming for 0.6090. So that should be it from all of us here at IronFX. Best wishes for solid trading.
Hello everyone, my name is Emily. In our video today, we will talk about why having a forex trading strategy is important. Trading on the global forex market presents the opportunity for a quick profit turnaround for traders and offers significant potential. However, as the most liquid market in the world, it is both complex and highly competitive. This means that in order to be successful, you need to have a solid trading strategy in place. Forex can be traded in numerous ways, so it is very important that you go with an approach that suits your experience level, budget, and trading goals. Having a proper understanding of the market you're entering into and the strategy that is needed can be the difference between trading success and failure. Choosing a forex trading strategy is similar to buying a new car. There are a lot of choices and they come in different types. It is also important that you test drive a new strategy via demo account before proceeding with it on the real world markets. Thank you so much for watching us today, guys. Bye-bye.
Ahead and get started. So today we're going to be talking about the turtle trading strategy. Before we get started, as per usual, just a risk warning as well as a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. The material is just the opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from or from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I'll be your speaker for today. I'm from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, here's our agenda for today. So firstly, we're going to be talking about who exactly were the turtle traders. So some background on turtle trading strategy. What exactly was this strategy? Breaking down the strategy, how we can improve the strategy in today's day and age, and crafting your own strategy around the turtle trading strategy. Okay, so let's go ahead and get started. Okay, let's get started. So here's the history or a little bit of background around turtle trading. It is a trend-following trading methodology that was developed by Richard Dennis and William Eckhart in the 1980s. So the turtle trading strategy, also known as the turtle trading system, is a famous trend-following trading methodology developed in the 1980s. So Richard Dennis was a prominent commodities trader, while William Eckhart was a mathematical genius and trading mentor. The origins of the turtle trading strategy can be traced back to a bet between Richard Dennis and his friend William Eckhart. So they had a disagreement about whether traders could be taught or if successful trading was an innate skill. So to settle the debate, they decided to conduct an experiment by recruiting and training a group of individuals who became known as the Turtles. So Richard Dennis believed that successful trading could be taught, while Eckhart believed it was a required natural talent. So Dennis, known for his colorful personality, famously said he could teach anyone to trade successfully if they followed specific rules. So the turtle experiment was aimed to prove his point. And this actually came after a trip to Singapore where they saw a turtle farm. And that's, hi Deepesh, welcome to today's webinar. Let me know if you can't hear me or can't see me as well. So this actually the idea for this experiment came after a trip to Singapore where they visited a turtle farm. So that's probably the reason why they called it the turtle experiment. So in 1983, Dennis and Eckhart selected a diverse group of people, and there were actually a couple of thousand of people who applied to be part of this turtle trading experiment. So they selected a couple of people from different backgrounds with no prior trading experience, and then they began their extensive training program. So they taught the turtles a specific trading methodology, which included entry and exit rules, position sizing, and risk management techniques. The core principle behind the turtle trading strategy was trend following. The turtles were taught to identify and trade in the direction of significant market trends, where they used a combination of technical indicators, such as moving averages, to determine entry and exit points. So we'll be going through a couple of these rules and strategies later on in this webinar. So they were also trained in strict risk management rules. They were instructed to follow a position sizing methodology known as the N unit. So this approach adjusted the size of their trading positions based on the volatility of the market, limiting the risk exposure. So you can see over here, I've indicated a little graph to show you what exactly the N unit was. So N equals to the market volatility. Here we have a, I wouldn't say a graph, but it's just a brief drawing of the volatility measured across a number of days. Then we used the DMA, 20 DMA, to measure the average true range of the volatility of the market. And this is how they were trained. So after the training period, the turtles were given trading accounts that were funded by Richard Dennis. And then they applied the rules that they had learned, and then they began trading his real money. So the experiment was eventually considered a success, as the turtles collectively generated significant profits over time. So at the end of the experiment, after a year, their total profits were $175 million. So the total trading strategy gained widespread attention and became well known in the trading community. The rules and principles of the strategy were eventually published in a book called The Complete Turtle Trader by Michael Covell, further popularizing the methodology. So the turtle trading strategy demonstrated that with proper training and adherence to a set of rules, individuals could achieve success in the financial markets, even though they had no prior experience. So it highlighted the importance of systematic approaches, risk management, and following market trends, and it continues to influence traders and investors to this day. Okay, so what exactly was their trading strategy? So some key takeaways from this, we'll go in depth a little later on, but for their specific set of rules, their entry was to buy when the price breaks above the 20 or 55-day high or low. And then similarly, you will go in for a sell if price breaks below this specific indicator. So for stop loss, it's pretty much subjective. It's solely based on your ratio, of course, but it was based, there was no specific rule for that. And for risk management, it was 1 to 2% of your account, and vice versa for short trades. Okay, so some key takeaways after the experiment. Even though it was considered a tremendous success, market conditions are always changing, and some question whether this style of trading could survive in today's markets. So the turtle trading is based on purchasing a stock or contract during a breakout and quickly selling on a retracement or a price fall. So he actually turned an initial stake of less than $5,000 into more than $100 million. So let's get into the specifics of the turtle trading strategy. Firstly, we'll go through the breakout trading, which is what I mentioned earlier, one of the main features of this trading strategy. And since it's also based on a trend following pattern, we're going to be talking about that as well. Position sizing and risk management, long and short trades, as well as multiple timeframes and diversification. So those are all of the ways that the participants of the experiment were trained to use this turtle trading strategy. So firstly, let's start with breakout trading. The core principle of the turtle trading strategy is to identify and capitalize on significant market trends. Breakout trading is a popular technique used by the turtles, where they enter trades when the price breaks out of a defined range or a previous high or low. So this approach aims to capture the momentum of a new trend and ride it for maximum profit. So in this case, they use the Donchian channels, which we'll get into in a little bit. Okay, next they looked at trend following. So turtles primarily focused on trend following, which means they trade in the direction of the prevailing market trend. So they use technical indicators such as moving averages or Dongtian channels to identify the direction of the trend. Traders can employ various trend following techniques to enter trades when the trend is established and exit when it shows signs of reversal. Okay. So next we have position sizing and risk management. So proper position sizing and risk management are integral parts of the total trading strategy. Risk management is still pretty important in today's context for any trading strategy, but we'll get into that a little later on in this presentation. So turtles use a method known as the N unit to determine the size of their positions based on the volatility of the market. That's what we mentioned earlier. So the idea is to risk a fixed percentage of their capital on each trade, ensuring that no single trade significantly impacts their overall portfolio. Next, we have the long and short trades. So since they're not only limited to only taking long positions, they can also utilize short selling to profit from the declining markets. By following the same principles of trend following and breakout trading, turtles identify opportunities to go short when a downtrend is established or when the price breaks below a significant support level. Okay. So multiple timeframes. Turtles often analyze multiple timeframes to gain a broader perspective on the market. They might use a higher timeframe, such as the daily or weekly chart, to identify the overall trend, while using lower timeframes like the hourly or 15-minute chart for precise entry and exit timing. So this multi-timeframe analysis helps them to capture both the big picture trends and the shorter term opportunities. So even though in this slide we are saying that they analyzed multiple timeframes, the main time frame that they use to actually trade on is only the daily time frame. So that was a rule that was set by the originators of this experiment to only trade on the daily time frame. So as we mentioned, if you were here for our multi-time frame analysis webinar, once you've decided on a specific time frame to use, then you could use either the 4 or the 6 multiples to gain a broader perspective on the market. So for example, if you were trading on, let's say, the 4-hour time frame or 1-hour time frame, let's say, then times 4 would be either the 4-hour, or if you were looking at a higher time frame, would be 4-hour, and if you're looking at a lower time frame, would be either the 15-minute time frame. Just so that you can get a bigger perspective on both the smaller time frame as well as the larger time frames. But we always go from a top-down approach when we're looking at time frames. So we typically will look at the daily time frame first or the weekly time frame, followed by either the 1 hour or the 4-hour time frame. But in this case, the participants of this experiment only looked at the daily time frame when they were trading. Okay. Next, we have diversification. So another aspect of the total trading strategy is diversification. Turtles trade across different markets and instruments to spread their risk and increase their chances of finding profitable opportunities. So they may trade commodities, currencies, bonds, or other financial instruments simultaneously, depending on their expertise and market conditions. Okay, so let's break down their strategy. Earlier we mentioned that they use either a 20-day setting or a 55-day setting. And I also mentioned that they solely only used the 1-day time frame. So here I have them side by side. Here is my 20-day setting, and here's the 55-day setting. This is a Donkian channel, just to be extra clear with you guys. You can see on the 20-day setting that the Donkian channel is much closer to the price. This is used for more short-term trading. Or if you are a scalper, this is the 20-day setting is recommended for scalping and short term. Whereas the 55-day setting, you can see that there's a lot more space between the prices, and they only really measure, or rather they only really take a look at the significant swing highs and swing lows and any small movement in price. Big movement in price, sorry, not the small movements in price like all of these. Whereas if we're looking at 20-day, you can see that there are these, it pretty much follows price more closely. So for on the 55-day setting for the Donkian channel, this is more for long-term traders because it's more refined, and this is typically what we recommend as well. It's a better way to trade as well, or it's more useful compared to the 20-day setting. Okay, now let's take a look at how we can improve on that strategy. So firstly, we have moving average. MACD, even though that's the first option, we either use MACD or moving average, but I'll show you guys on TradingView in a little bit on how we can make use of both of these indicators to improve the total trading strategy. Okay, so here's the moving average that we can use from the Donkian channel. I'm just going to go ahead and open my TradingView to show you guys how exactly they used it. Okay, so over here, we're looking at Euro USD. Let me just clear my charts. Okay, so they analyzed it solely on the daily time frame, but as we mentioned earlier, they did look at the weekly time frame. So let's go ahead and look at weekly as well. Okay, so here we have the weekly time frame. You can see prices have climbed up from this swing low, but it does look like price is reversing off of this level over here. This is our weekly time frame. Okay. Okay, my mouse isn't working today, so I have to use the keypad, or rather the mouse pad on my laptop. So if you can hear that, that's the sound of the clicking. Okay. So here we have the daily time frame. You can see prices are climbing up. So I'm going to pull out our Donkian channel. So here we are using the 20 length time frame. I'm going to go ahead and remove our moving average first. So we're just solely looking at the channel for the time being. Okay, so how they trade was that, for example, over here, if price made a lower low, so for example, over here, we see price has made a lower low over here, then they will go in for a sell. That's basically the rule that they had. So from here, if price cuts below the previous low, then they will go in for a sell, sorry. Yeah, but if we're talking about stop loss as well as take profit, as we mentioned earlier, stop loss is it was subjective. There wasn't really a set rule for that. So if you placed your stop loss over here, or rather if they placed their stop loss here, they would have gotten stopped out. right? So if we go back, let me zoom in. Okay, so we're looking just solely over here. So if, over here, sorry. So once price made this lower low, from here, it made a lower low, it cut below this area here, right? Then they went in for a sell. But if we had placed our stop loss over here, so you go in for a sell from here, you're expecting prices to drop. If they had placed their stop loss right at the entry over here, they would have gotten stopped out because price rose up before it continued to go back down. Right? So price, which is why we always recommend you to place your stop loss before any big area of confluence. And what we mean by big area of confluence, over here we have this swing low here, as well as a swing low here. So this area, okay, let me just get rid of this. So when you have this area here, this is considered an area of confluence since price has tested this area many times before. Okay, see, I can even drag it all the way back over here. Okay, price testing this area many times. So this is what we call a confluence area. So for them, once price cut through here, this specific area, which is our previous low, they're going for a sell over here. Stop loss is subjective. So if they had placed it anywhere over here, they would have gotten stopped out because you can see price reversed up over here. That's why we always say we want to place it before any major confluence area. So again, to risk management a little later in this presentation, but I just wanted to point that out since we're looking at a chart now. Okay, so then they would have gone in for a sell and they wouldn't know because these people don't have prior experience. So they would have gone in for a sell, just wait for price to drop all the way until here. So this could be our take profit over here. So that's basically how they traded. It's using the Donchian channel. Basically, when price keeps making a lower low, then they just go in for a buy or a sell. So maybe another example that we can have over here would be at this take profit, where price made a lower low over here. The minute it cuts through here, they will go in for a sell. But you can see price reversed all the way until here. Right? And once again, this is a significant level because price has tested this. We have two multiple swing highs here. So this, once again, is a confluence area. So if they had placed their stop loss over here, they would have gotten stopped out. So we always recommend place it before your confluence area. And then you can see it go down, then they would have made a profit over here. Okay, so that's basically how they use just channel. So now let's take out let's add, okay, let's also change this to 55. So this is why we say that using the 55 would be better because previously on the 22, okay, let's change it back. You can see on the 20, it's following price very closely. So it's a little bit difficult to see if price made any lows. Whereas when we have our 55, you can see really clearly. You can see from here to here, for example, where I pointed out earlier, it's very clear that price made another low after this previous low, even without my support level. So here, one look, you can see exactly where price has made a lower low, and then that's where they will go in for a sell. So that's just the Donkin channel alone. Let's add the moving average. Okay, so similarly, as we mentioned earlier, they would go in for, they're looking out for breakouts. So an example of this would be over here, for example, price is moving below the moving average, but then once it comes up above here, above the moving average, they will go in for a buy. Which of course you can see that it did drop, which is why we say again, depending on where the stop loss is, if it was here, it would have been fine, but if it was exactly at the swing low, they would have gotten stopped out before price reversed. Because you can see price did reverse here, and then it went back up, and they would have made this much of a profit. So it's not the best trading strategy, of course. Now that we are in modern day and we know some other trading strategies, but this is basically what they did. A very simple set of rules to follow, which actually resulted in them making a big amount of profit in the span of 1 year. And the thing is that they couldn't miss out on these breakouts as well, because since they're trading on the daily, they only have 365 days minus the weekends to trade as opportunities for them to trade in the experiment. Okay, so whenever they saw a breakout like this, they had to go in for it. Okay, I think another thing that helped as well was that maybe because the financing wasn't exactly their money, so they didn't have the issue of emotions that most traders face, since most traders would be trading with their own money. Yeah, but the money wasn't theirs, and they also had the confidence of an experienced trader backing them up, telling them that this strategy was going to benefit them. So since they didn't really have any emotions as well as insecurities that were tied to this trade, it was probably easier for them to trade as well. Okay, so that's basically the gist of what happened or how they used to trade. So let's get back into another way that they use this trading strategy. So after using the Donkin channel, they also made use of stochastic. So let's go ahead and look at that. Stochastic is a let me just change this. Okay, it's fine. It's an indicator that we like to use as well, because it shows us the momentum of price as well. So typically in today's day and age, how we use stochastic is by looking at trend breakouts. It's by looking at divergences as well. If you were here for our stochastic webinar, you would know that. So similarly, how they used it as well in combination with the Donkian channel is by simply looking at whether it's overbought or oversold. So you can see over here it's oversold, right? So then they were going for a buy. That's basically how they used stochastic. So they didn't look at divergences at hidden resistance and support levels like we do today. They just looked at if it's overbought, then they were going for a sell. If it's oversold, then they were going for a buy. That's what they did back then. Okay. Okay, let me know in the chat if you guys have any questions as well. We're just going through what exactly they did and how exactly we can improve on it with our hindsight, now that we know better. Okay, so now let's talk a little bit about trade management, which I mentioned a little bit earlier on. So why is trade management so important? So firstly, it's to control risk. So by having trade management strategies such as stop loss orders and position sizing, it helps traders to limit their potential losses and manage their overall risk exposure. So earlier on, I was talking about how where exactly is a good idea to place your stop loss. In terms of position sizing in the context of the experiment, they actually position sizing, they only placed 1 to 2% of their total capital. So the total capital that the original creators financed for them, they were only allowed to use 1 to 2% per trade. So that helped in terms of position sizing. Stop loss was completely subjective and completely up to them. So in today's context, when you are trading with your own money, position sizing, it's again up to you in terms of your capital and your risk appetite. But leverage and margin would help a lot as well in terms of what lot size and what position sizing you would want to use. Okay, secondly would be to maximize profits. Trade management strategies such as take profit orders and trailing stop loss would help traders to lock in their profits and maximize their returns. Third would be to manage your emotions. So as I mentioned earlier, these participants weren't exactly trading with their own money. So perhaps this wouldn't have applied to them. But for us as normal traders, the discipline and structure that trade management provides can help us to stay calm and rational, even in volatile markets, which can prevent impulsive decisions driven by fear or greed. Okay, number 4, to improve trade efficiency. So if you have a well-defined trade management plan, traders can make faster, more informed decisions and avoid the cost and time of having to constantly monitor and adjust your positions. And lastly is to increase consistency. So effective trade management rather, can help traders to achieve consistent results over time by reducing the impact of individual losses and maximize the impact of winning trades. So in summary, trade management is important regardless of what trading strategy you use. If you're interested in using the total trading strategy, it's important to implement your own trade management as well. Okay, so right now let's take a look at some trade management strategies that you can implement together with total trading strategy as well. So earlier on, I was talking a bit about confluence. Over here in the slide, we're talking about Fibonacci confluence, but as I mentioned when we were looking at the chart, it's confluence pretty much for anything. So if you have a couple of swing highs that lie in the same area, that's a pretty strong level. And if you combine that together with, let's say, a Donchian channel or a pivot point indicator, and all of those levels line up, that's a confluence area as well. So it doesn't only have to be for Fibonacci. But in this case, we're talking about, in this slide, it's talking about Fibonacci. Okay, so stop loss, earlier I was mentioning that you place your stop loss beyond a key confluence area. Why? Because price is attracted to strong areas of confluence. So earlier on I showed you that if you placed your stop loss right before a area of confluence, then you'll get stopped out. So similarly, if your stop loss is right before instead of beyond it, you'll likely get stopped out before the market reverses, which is what I showed you guys in the chart. So take profit, on the other hand, we want to place it before a key confluence area. And why? Because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it reverses back to your entry, or even worse, to your stop loss. So this is also one of the reasons why people complain that the market is being manipulated, because they miss their take profit by 1 pip. Okay, so here's just a diagram to show you the proper stop loss and take profit placement. So this applies for really any kind of trading strategy. So the proper stop loss and take profit placement ensures that you maximize your wins and minimize your losses. So for example, in this example over here, I showed you guys this red area is our confluence area, and that's where we place our stop loss beyond it. So over here you see similarly major resistance area, which can be considered as our confluence area, stop loss, we'll place it beyond so that we don't get stopped out. Similarly, for take profit, we want to place it before a major confluence area so that there's a higher chance that price will hit our take profit before reversing off. So let's see if we can find any potential take profit areas. Okay, so for example, over here, okay, if I had placed my, okay, let's say, here, okay, this is my area of confluence, and I'm expecting price to go back up here, right? Because as we mentioned earlier, the participants, once price breaks out of our moving average, they will go in for a buy, right? But then we can see after they go in for a buy, it drops down. So in the same way that we would place our stop loss after here, just in case price reverses off, which it did, once it goes back up, where will we place our take profit? So since stop loss, we place it above. If we place it over here for our take profit, it would have missed our take profit before reversing back down, right? So we would place our take profit before. And you can see that the candle wicks just nice touch our take profit. Okay, and that's why it's so important for you to place your take profit before a confluence area. Okay, let me know if you have any questions, but we're just going to go through some risk management techniques. Okay, so here we have break even. So I'm just going to briefly go through these trade management techniques, but we go through them in depth in our upcoming trade management series, so keep an eye out for that. But here's just a brief run through that you can use in combination with the turtle trading strategy. Okay, so break even. Break even is a level where you are in profit and recognize that there's a risk of a reversal, which basically means that price is going to hit back to your entry. So it is basically saying if I am right, price should go all the way back to my target, but if I'm wrong, I should get out. Okay, so let's take a look at the diagram here. Here we have our entry firstly, which is the blue dotted line. Buy entry on breakout, hoping for price to push to our take profit. So the gray highlighted area here is a double swing high resistance. And you can see price has broken out of this resistance. So we're expecting it to continue to rise. We're expecting to continue to rise and head towards our take profit. And our take profit is over here at this green area. Okay. But you can see our original stop loss is way down below here. Even after, or rather beyond, as we mentioned earlier, it's beyond this swing low over here. Okay, so between the blue and the yellow dotted lines, price is trending, it's moving upwards, right? And then it goes up above this this level here, and we're expecting it to hit our take profit, but we can see that it reversed right over here. So if we're not entirely sure whether price is going to hit our take profit, that's where we add our break even, which is at our, or rather, it doesn't have to be a swing high, but it just has to be at a level that's in between your take profit and your entry. Okay, so to minimize losses even more, we changed our stop loss. So we placed our stop loss at our break even, or rather at our entry, which is over here. We place our entry to protect our position. So if price continues to rise, it's a good thing, of course, but if it reverses, we want to be protected and to get out as soon as possible. So we got out of this losing trade at break even. So we got out over here because you see price definitely reversed off and we got stopped out here. So if we had left our stop loss over here, we would have lost a lot more money. Okay, next we have idea invalidation. So idea invalidation is usually placed before your stop loss. Is the level which you basically admit I'm wrong, let me get out. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So let's look at the diagram here once again. Your entry, same thing is over here. We're expecting price to drop all the way down to our take profit over here. Okay, so it's going down nicely, and then over here it reverses and it heads back up. So once it hits our entry, then we realize that we're wrong, and then that's where we place our take profit to our entry. So that gets us out of our losing trade. So you can see once we've realized that we're wrong, we place our take profit at our entry, and then we get out of the trade at break even before price rises further and would have stopped us out. So this is two ways in which you can minimize your losses. Okay. Okay. Here we have different methods of trading stop loss. So this is another way to minimize your losses is by having a trading stop loss. So there are many different methods. So I'm not going to get in depth. I'm just going to briefly mention a few. So here we have moving average, which is the first one, followed by parabolic star, chandelier, and ATR indicator. And then over here, we have the support and resistance levels and a combination of these methods. Okay. So these are really important when you are using any kind of trading strategy. Doesn't even have to be a turtle trading strategy, but since we mentioned earlier, by looking at the turtle trading strategy, where exactly are good places to place your stop loss as well as your take profit to maximize your returns and minimize your losses, I figured we just add this in as well. Okay, that brings us to the end of our webinar. Let me know if you guys have any other questions, but thank you guys so much for coming to our webinar today. Hope you guys found it helpful, and I will see you guys next week. Bye! Feel free to let me